Hello. 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 Hello, everyone. Welcome to SM 131. Hey, the microphone's not behaving well. The microphone's okay. It's good. It's good, Mike. It's good up front. Is this microphone working in the back? I don't know. I can't tell. Nobody's responding in the back. In the back, can you hear the microphone? Professor Van Alstyne can hear me in the back room. Why, hello, Marshall. How art thou? Hi, everyone. Thank you so much for coming today. As you know, we have an exam at 6:30, and so this is a perfect time to introduce corporate governance at a moment when everyone is laser focused on corporate governance and also laser focused on the exam for tonight. I'm mostly stalling at the moment because everyone can sign in with the QR code. If you are unable to sign in with the QR code, if for some reason the Quickly isn't working, take a selfie of yourself and email it to me. If you do it now, then I'll know that you were here on time. Some folks are going to wander in a few minutes, maybe 10 minutes, maybe 30 minutes. When they get here 45 minutes from now, they're going to say they got here 5 minutes after class started. That might not be exactly accurate, but you are all here now, so thank you so much for coming. Again, I know it's not the easiest thing to do to attend a lecture on the same day that you've got an exam, so we absolutely appreciate your being here. You are here for good reason. We have quite the program for you. We have a series of presentations by honors students, followed by a panel discussion with outstanding panelists. All of this has been prepared through the work of Faculty Director of the Honors Program, Patricia Cortez, and with the wonderful input and structure of our Mehrotra Institute. One of our directors, Nalin Kaletalaka, is here. I believe that Professor Marcel Rindesbacher is also here, but I may have missed him. We are also joined today by our illustrious Dean of the Questrom School, Professor and Allen Questrom Dean Susan Fournier. We have Dean Rachel Reiser with us. We have Dean Kathy Fazio with us. There's Professor Marcel Rindesbacher. We have Professor Kurd. I think that's Professor Keith Ericson. We are joined by stars. I think we have Professor Estelle Sun in the middle. You're surrounded by excellence. On stage, however, is a mediocrity, and that is me. And this, I am now going to make a request, and that request is, I'd like us to be fully electronics free once you've done your QR code. So once you've done your QR code, please put your laptops into your bags, close up those laptops, put them in the bags. We have far too many exciting, fun things to discuss. And so we won't need your laptops for those. I promise that but for a bonus question, the content from this session will not be on the exam tonight, but I can also promise that it will be on the exam number 3. But you won't need to have taken notes on your laptop for that. So please put the laptops away, put your tablets away, and then once you've scanned in with the QR code, also put those phones in a bag. The content will be far too exciting and far too interesting to be distracted by anyone else, and also far too important content to exert a negative externality on your neighbors by having those things out. Okay, I think that I have spoken far too long and far too rapidly. What I ought to be doing now is introducing our first team. We're going to have 3 teams of honors students who have been researching topics on corporate governance. They're going to introduce their research questions. They're going to introduce the background research that they have done. They're going to tell you about a case study associated with the topic that they have been examining. We will see 3 of those. Then we will have a panel discussion moderated by one of our star honors students. Professor Cortez will be keeping track of time up front. Any announcements I've missed? No? Then with no further ado, let's call up our first team of honor students to present on corporate governance.
Hello, everyone. Thank you all so much for taking the time to be here. Today, me and my team will present our senior capstone project on the relationship between ESG practice and a firm's financial performance and market outcome. My name is Ivan.
Hi, everyone. My name is Ainsley.
I'm Danvi.
I'm Liz.
And before we start, I want to give a huge shout out to Professor Sun and Professor Cortez for serving as our faculty advisor and always providing a tremendous amount of support and guidance throughout this entire project. Without them, we wouldn't be where we're at today. And so this is the agenda for today. First, we will give you guys a brief introduction as to what is ESG and why it matters in today's society. And then we're going to present our research question and our motivation behind it, followed by our literature review and case study. And lastly, we will wrap up with some key takeaways from our research findings. And so ESG stands for environmental, social, and governance, and it is a framework to assess the performance of a company beyond its financial metrics. And so the environmental part focuses on how a company's actions impact environmental related aspects such as natural resources, the natural habitat, and the climate. And the social part focuses on how well the company treats its people, its employees, and the local community in which it serves. And finally, governance is all about the company's quality of leadership, oversight, and ethics. And so why does ESG matter in today's society? Well, in today's business world, ESG has become increasingly important because various stakeholders like investors, customers like you and me, and employees are paying more attention to how responsible a company operates. An example would be how investors and consumer groups have been pushing Starbucks to reduce its environmental impact. And we can see this through Starbucks drastically decreasing its usage of one-time use plastic straws and increasing its use of reusable and refillable cups. There has also been a rapid rise in ESG-related investments as more and more firms recognize that strong ESG performance can directly lead to increased trust and long-term value. A recent example of that would be how Google and Amazon has recently increased its investment in renewable energy procurement and carbon reduction initiatives. And at the same time, ESG factors may or may not directly influence a company's financial performance and stock valuation, meaning that at the end of the day, being socially and environmentally responsible can make a company more profitable. And that brings us to our main research question: how does ESG impact a firm's financial performance and market outcome?
The motivations behind our research question are threefold. First, we focus on financial performance because typically firm performance is measured through financial metrics such as profitability, returns, and stock performance. Next, the business environment has undergone major shifts, and ESG has transformed from a niche concept to a mainstream consideration for all stakeholders. Firms today are expected to consider the impact of their decisions on the environment, society, and internal governance. And lastly, the research that explores the link between firm performance and ESG is not all uniform. Some research indicates there's a strong positive link, whereas others suggest more neutral or context-dependent findings. And that inconsistency is what ultimately motivates our research. Our research highlights three main themes from the literature. First, research generally shows that ESG supports firm performance. The majority of the literature explains how firms with ESG initiatives experience higher profitability, stronger stock performance, and more resilience, especially when governance and oversight are strong. Next, ESG is a long-term play. Benefits from ESG, such as risk reduction, stakeholder trust, and sustainable growth, all accrue over a long period of time and not immediately. And lastly, not all evidence is positive. Neutral findings suggest that ESG initiatives do not guarantee outperformance, but rather results depend on the industry, market conditions, and whether ESG initiatives are implemented authentically. Overall, ESG can enhance firm performance, especially over the long term, but only if ESG initiatives are implemented meaningfully rather than superficially, and if it considers the context of the external business environment.
In order to truly quantify this impact, we looked into Volkswagen, which is a household name and a German automaker company with subsidiaries like Porsche, Lamborghini, and Audi. We looked into Strategy 2018, which reflected their very ambitious goal to become the world's largest automaker by 2018 and meet some very high diesel standards. This reflected some very strong weaknesses internally. For one, they already had a very poor board structure. Only 1 out of 20 board members at this time were truly independent. Secondly, they were able to further some serious ambitions without ethics. This led to a lot of approval of very deceptive software in their cars and high pressure for management to meet these standards reflected in Strategy 2018. Finally, both of these together created a strong culture of fear within the company. Members and employees were very scared to conduct whistleblowing, and there were very few avenues for reporting these unethical standards. Altogether, this led to the scandal called Dieselgate. About 11 million cars had deceptive softwares installed in them to cheat emission tests and standards. We looked into the market and financial impacts of this Dieselgate scandal. On one hand, we see that the market was heavily impacted, and as was Volkswagen's reputation. The stock price dropped about 30% in just a short span of a couple of days. Together, they lost about $31 billion in market value. On the other hand, internally, their net income, as you can see here, reached an all-time low in 2015 and was unable to recover to pre-scandal standards until 4 years after the scandal occurred in 2019.
Looking at it more from the consumer side of things in terms of media newsline reactions, as you can see, the search results for Volkswagen immediately following the EPA's 2015 announcement immediately began to skyrocket. We saw media attention coming from all different companies across different countries, as well as we saw multiple different news sources in the US and other places as well, definitely grabbing onto that immediate attention. On top of that, Dieselgate became synonymous with this scandal as Volkswagen itself have been known for their clean diesel initiatives. This was a complete detraction and showed the consumer distrust in the company that they have been working towards for years beforehand. Some of the key takeaways we get from this case specifically is that a weak board, overly ambitious goals, and poor reporting culture damaged the company's outlooks. Their bottom line decreased, stock price decreased, and their market reputation had a huge impact based on what happened during the scandal. They lost a lot of consumers' trust, and that also impacted later down the line how they were able to recover from the scandal as well. This shows us that while you can have a strong goal towards what you want to do, if you don't follow through that goal with the correct governance structures, and as well as you try to cheat the systems by doing things differently, it shows that market reaction to that is negative following the scandals. So in order to answer our research question, this is what we came to as our conclusion, is that ESG enhances firm financial performance and market outcomes through improved governance, long-term strategic orientation, and risk mitigation. Thank you.
Good morning, everybody. Is the mic working? Good morning, everyone. let's get it started. Today we'll be talking about corporate purpose, stakeholders, and emerging challenges. But first of all, my name is Janelle.
I'm Alex.
I'm Kush.
And we'd also like to give a brief shout out to Professor Ericson and Professor Cortez for their support and guidance in our research. Who knows where we'd be today. Okay, so for a brief overview of what we'll be talking about today, we'll first be introducing our question, also a breakdown of corporate purpose, a couple of different business structure varieties, and also our case studies. Now, from an outsider perspective, business is seen as inherently evil and detrimental to society and the environment, and the list just goes on. This kind of prompted our thinking to who makes these decisions and why does this happen? Leading to our business question, how does the distribution of stakeholder power shape corporate purpose? Now, this seems like a really daunting question. To break this down, we'll be going through C corporations, public benefit corporations, and lastly, cooperatives. We'll also be breaking down corporate purpose. Now, who in this room can actually tell me what corporate purpose means? I'll be taking any volunteers at all. One hand up. What's up?
Corporate purpose, is it the reason the corporation has for conducting its operations and activities?
You just took the next slide out of, don't even need to present anymore. But yeah, corporate purpose is the fundamental reason a firm exists. Essentially, what a company seeks to achieve, whom it will serve, and how it will create value. And we will be tackling this and also revisiting corporate purpose as we go through the presentation. I'll now be passing it off to Sydney, who will be breaking down the different business structures.
There are two major schools of thought regarding the purpose of a corporation. The first school of thought is the shareholder side. Shareholder is a bit older, supported by the Business Roundtable in 1997. And this view states that the shareholder should be in a decision maker's mind throughout the entire business process. This usually leads to profit maximization, which means making as much money as possible for shareholders. However, more recently, the Business Roundtable in 2019 has supported the stakeholder view. Under the stakeholder view, there are 5 important stakeholders: the customer, supplier, local communities, and the shareholder, as well as employees. Under this, it is not success that is profit maximization, but relationship management. However, today, for-profit corporations overwhelmingly use the shareholder perspective. But is this what shareholders really want?
According to a 2024 study, only 7% of individual shareholders actually want profit maximization, with 42% of shareholders actually favoring welfare maximization over profit maximization. In other words, if a company has an option to lower their prices, even if it hurts their profits, 93% of the population would want them to do so. But this isn't the case. If this is the case, then why do we still see problems with our corporate purpose? Well, economist Henry Hansman believed that this gap was in the corporate power. See, that 93% probably isn't the group making the decisions. So Hansman proposed, instead of taking a look at what corporations are doing, maybe we should take a look at who is making those decisions. He believed that the optimal owner is going to be the one that minimizes 2 costs: the cost of ownership and the cost of contracting. The cost of ownership is the cost to the company under a particular owner. So one of these is going to be decision-making. Let's say Amazon gave an equal share of their company to every single person in the world, and now they had to make a decision. Let's say they're deciding whether or not to sell giant wheels of cheese. Quick raise of hands. How many of you think Amazon should sell giant wheels of cheese? Cool. So if I had the patience to go through and count all of you, it would still take me a really long time, and we still might not come to a decision. This is a problem. If you have too many people in the decision-making position, then it slows down our operations and will be detrimental to the company. Let's take the opposite. Let's say now I am the sole owner of Amazon, and I really like cheese, so I'm going to say let's go ahead with this venture. Problem is, each of those wheels is probably $4,000, and I don't know about you, but I don't have that kind of money. Cost of my ownership is going to be my ability to obtain capital. The major solution for this is the stock market. We see companies trading ownership for capital gain. The second type of cost is the cost of contracting, or the detriments to the stakeholder under a particular owner. So let's say Amazon is really successful in selling these wheels of cheese, but the problem is now Italy has all this pollution because of the transportation of all this cheese. Now, we could invest into eco-friendly policies to make ourselves more socially optimal for Italy, but I don't live in Italy. Why should I care? This is the problem. We don't have intrinsic incentives to put social benefit unless we are tied to it. So under Hansman's theory, the best owner in this scenario would be the people of Italy. Of course, they would invest in these eco-friendly policies because they're directly influenced by those decisions. Now, again, as we mentioned before, then we run into decision-making again. If everyone in Italy had an equal stake, then we'd run into a similar problem. And so Hansman's theory is all about balancing these two costs. So let's take a look at 3 business models and how they fall under Hansman's theory. So you all know and love C corporations, and they do a great job with costs of ownership. The C-suite executives and the board of directors creates a centralized decision-making body for the company. And because a lot of them are public, they have ways to obtain capital. The problem is they are pure profit incentives, and without a direct stakeholder power in there, they have no reason to do otherwise. B Corps are sort of a solution to this. They have all the benefits of a regular corporation, but now you also have the social purpose ingrained into their total structure. However, in Hansman's theory, you're not actually really changing the owner. You're just saying that we're going to be more dedicated to the stakeholders. So we face a similar problem. The one we're going to be focusing the most on, and one you might not be familiar with, are cooperatives. If you don't know, a co-op is a model where it's entirely owned by a particular stakeholder, usually either the producers of the product or the consumers. You probably already know a couple of these companies, like Ocean Spray or Land O'Lakes. And the reason that these are successful is because they have a small customer base or a small producer base. What we want to take a look at with our case study is going to be an industry that is highly competitive, where cooperatives might have a little bit more difficulty.
And that industry is the outdoor industry. So I'm sure you're familiar with all these companies, but going down the line for C Corporation, we looked at Columbia. Some of the unique benefits to have are similar to the ones that the competitors in the C Corp have. So things like making their supply chain greener, having employee programs like well-being programs, resource networks, et cetera, right? So they are stakeholder focused, but at the end of the day, they're a public company with a share price and profit goals to hit every single quarter. So in the end, their shareholders are deciding the foundation of company longevity. For public benefit corporations, look at Patagonia. Now, Patagonia is a very unique case study because they're one of the leading public benefit corporations, not just in the outdoor industries, but across all industries, right? They have 151 on the B Corp impact assessment when the median score is only 50.9. Now, that's very important because as an operating company, they operate through a trust, right? So that means is that all of the shares for voting are held within the trust, meaning that only trustees can make decisions for the company. And what that means is that for the mission of the company, for Patagonia, which is to reinvest profits into the environment, that vision is going to be protected. So no other external shareholders can come in, try to take over, and make it a more profit-motivated company. It's not really a drawback to that other than the fact that it's a very small number of companies, right? Not just in the outdoor industry, but also in terms of all companies in general. Lastly, for consumer cooperatives, we looked at REI, who have, looking at their financial performance, have generated $3.5 billion of annual revenue, but have incurred a loss of $150 million. This due to the fact that as a cooperative, they're giving unique benefits to their members, such as incentives and profit sharing, as well as dividends within rewards. They also have other programs like a fund that donates to local community initiatives for the outdoors, as well as different programs for policy making. Now, with this, the issue with this is the fact that choosing the stakeholder focus, right, their consumer focus, decisions have been made since the pandemic that have been at the disservice of employees. So if you look at the next slide, in 2025, REI announced that multiple locations, including ones in Boston, New Jersey, and New York City, will be closed because, in the end, they're not generating enough profit to make sure that these businesses are being run, properly. And what that means is that REI is struggling by not maximizing profit because, with fewer stores, that means that employees are losing their jobs, at reducing their welfare. There's less revenue streams for the members, so they're not going to be able to make revenue in the long run, which is again reducing welfare overall.
Understanding our business cases, we see that our key takeaway is that stakeholder involvement alone does not lead to profit or welfare maximization. Instead, a company needs to take into account both stakeholder involvement and proper administration for success. Thank you.
All right, thank you everybody for coming out to the last session and the last presentation of the last session. Today we'll be talking about corporate governance of high-risk technologies. This is AI regulation in the US and how we can mitigate externalities. It's over. I mean, Isaac Asimov was talking about this. The older folks in the audience will know. Robots are going to take over the world. Elon Musk is going to put Neuralink AI chips in our brains and it's going to control all of our behaviors. Other experts are talking about just the growth of AI needing all of this energy means that we're going to have to carbonize again, going against decarbonization, burning all this coal for energy. All of these problems are arising. And again, this Knight's First Amendment Institute was created just to address these problems and talk about the future risks of AI. But seriously, on a professional note, that was an exaggeration, but the world could look like that if the United States government doesn't step in. So the real problem is that AI growth is unprecedented. We see it with scientific publications and Gen AI patent families. These are patents per one innovation. So we see that innovations now, different AI algorithms are now reaching 15,000 and beyond. And especially after the release of ChatGPT, we're talking about tens of thousands of scientific publications and unprecedented growth, which is posing a significant challenge because we don't know where this is going. Well, let's take a look at it further then. Tencent Holdings in China, most of these are Chinese companies and Chinese universities, already has 2,000 different AI invention patents, and this is only at the end of 2023. So this is an exponentially increasing curve of unprecedented AI growth, and someone needs to come in and stop it before, yes, Elon Musk puts AI chips in our brain. So this begs the question, what can regulation do to solve this?
So we are asking how U.S. regulation can effectively govern the implementation of AI in society to balance the positive and negative externalities on our society. That begs the question, what is an externality? An externality is a cost or benefit not realized by the one actually making the decision or taking the action itself. A great example might be pollution. One would be able to pollute the air without paying for it, but that cost and burden would be borne by all in society, so government intervention may be warranted to fix that market failure.
Now, how does AI fit into all this? With AI at the forefront of today's news, it is important to recognize that AI has both positive and negative impacts on society. First, AI can improve the workplace, such as productivity and lower costs. AI can also aid discoveries in science, technology, medicine, and help solve environmental problems. However, it's equally important to recognize that AI can have many negative externalities in society, such as powering data centers consumes massive amounts of energy, which drives up energy prices, and of course, carbon emissions with generating that electricity as well. Also, cooling data centers also requires lots of water, which can damage ecosystems and the environment as well. AI also has many social impacts, such as spreading misinformation through hallucinations, and of course, spreading biases. Now, how is AI governed throughout the world? Let's take a quick look at the US and the EU, for example. Starting with the US is the land of the free. Free markets, free speech, and minimal regulation. While they don't have any binding regulations when it comes to developing AI, we have voluntary AI risk management frameworks that allow corporations to implement whatever they want into their corporate governance structures to see how they best think that they can manage their positive and negative externalities. It's also important to notice that this current administration revised the AI risk management framework to remove all references to misinformation, DEI, and climate change. Now we'll take a look at the EU. The EU does things much more differently. They are more proactive, and they have the binding EU AI Act, which puts strict requirements and harsh penalties for non-compliance on AI developers. So, in sum, the EU does much better with managing negative externalities, but the US harbors better positive externalities, and this shows by the fact that the US is clearly dominant in the global AI race, with companies such as OpenAI, Anthropic, Google, Meta, and xAI, for example. Now we'll take a look at OpenAI as a case study for demonstrating how current existing US regulations are flawed in managing the positive and negative externalities of AI. As we know, OpenAI was founded in 2015, and they offer platforms such as ChatGPT, DALL-E, and Sora. AI was founded with the mission to ensure the development of AI benefits all. And to accomplish this, they have a unique board structure. They have a two-tiered board in which a board of directors oversees a nonprofit, which controls a capped for-profit entity. However, it's important to note that this board structure, along with its evolution, is not without its flaws. Now we'll take a look at two examples and how this demonstrates flaws in current regulations. First, the removal of Altman as CEO. In 2023, this board of directors briefly removed Sam Altman due to a lack of trust and communication of his mission. However, employees threatened to quit and investors threatened to pull their money, and subsequently, Altman was reinstated as CEO. Second example, as of last month, OpenAI converted from a nonprofit overseeing a capped for-profit entity to a nonprofit overseeing a public benefit corporation. This is a relatively new legal entity which balances both profitability and social good in the pursuit of their corporate activities. However, it's also important to note that this paves the way for an IPO when they hope to do so in late 2026, early 2027. This is going to greatly increase investor pressure. And it is also important to note that this switch happened over many, many years through deliberations and legal challenges. And it's important to notice that only two people held the power to grant them this switch, the Attorneys General of California and Delaware. Now, what are some takeaways from this case study when it comes to regulation? Well, first of all, corporate self-governance. As we saw with the removal and subsequent reinstatement of Altman as CEO, corporate self-governance is somewhat flawed in keeping corporations accountable to remove potential negative externalities. If employees and investors essentially have the power to veto the board's actions, then corporations cannot effectively self-govern themselves. Second, let's take a look at the public benefit corporation. This greatly increases investor pressure as it allows firms to IPO. And even though the PBC is supposed to increase a firm's duty to social benefit, it may actually have that opposite effect, because investors can easily punish a corporation for poor financial results, but those that are harmed by negative externalities, such as the environment or me and you for misinformation, cannot easily punish corporations for their bad activities. Now, finally, we'll take a look at lacking legal precedent. As we saw with OpenAI's switch to a PBC, this unfolded over many years and through lots of legal troubles. And the fact that only two people held the power to grant them the switch shows that there is a lacking legal precedent for these complex board structures. This harms innovation as it makes it harder for newcomers to enter the industry and compete and innovate, which means that current US regulatory frameworks cannot fully capture the positive externalities of AI.
All right, thank you so much, Jordan. And so as we just talked about here, the current regulatory framework and the firms themselves and all of their corporate governance structures won't hold themselves accountable for all of the harms that they have on society. So that means we need to have proactive legislation and a proactive framework in place that'll predict these future harms and hold firms accountable now so we can avoid all of those problems in the future. Now, we do know that regulation improves future outcomes, but the real question is how much and who's going to win? We want to position ourselves in the United States to have the most competitive and innovation-booming regulatory framework so we can encourage all of these top firms like OpenAI, Anthropic, et cetera, to come innovate in the US and feed our economy and society. So this begs the question about policy goals.
So what are we trying to do? We are trying to create a system where our AI companies are able to innovate effectively while being responsible and deliberate in their development of AI technologies. We want to make sure that our AI technologies are able to be used effectively. One of the best ways to make sure that AI development benefits all people is open source technology. This means that instead of being owned by a for-profit private entity, it would be in the public domain and could be used by different parties to build on top of. A great example of open source AI would be Terrier GPT. I don't know if you've ever used it, but great stuff. And we also want to make sure that the risks of AI are effectively mitigated. That means we want to ensure that we're able to ensure that the development is slow and deliberate and that it is not exceeding our ability to control it. We want to make sure that AI works for us, not against us. And finally, we want to make sure that we're able to address the climate and social concerns that AI develops, carbon taxes or greater investment in solar and other renewable forms of energy might be able to offset some of these very negative and harmful consequences of AI development and use moving forward.
Thank you so much, everybody. Thank you. Thank you. Very nice. Thank you. Oh, you'll have 2 hours. Yeah. Well done. I don't know if Marshall knows who's coming up.
Marshall, we need you here, and Jesse too. Now we'll have our panelists, and here's our Constantine being the moderator.
All right, thank you, everybody. We'll wait for everyone to come up.
Excellent.
You can either go with a lapel microphone or we'll take one of these. It'll be fine.
Work? Maybe it works.
Okay. We all set?
I don't know if I'm all set. Does that work?
Can you try talking?
I can try talking. Can you hear me?
Well,
Is it on?
that's good.
Great. Thank
I
you.
think this works. Yeah.
All right.
Okay.
Perfect. Thank you, everybody, for coming out to the last session and the last panel of the day. We're delighted to welcome both of these folks, Jesse Coleman and Professor Marshall Van Alstyne here. Let me introduce them both really quick. Jesse Coleman, seasoned clean energy advisor and executive leadership coach, driving strategic innovation for the future, worked with a lot of startups, US government, and Fortune 500 companies. A big history of driving a lot of innovation and profit. Very highly educated at Questrom MBA, so we're very proud of that. Excited to have him here. And then Professor Marshall Van Alstyne is one of the world's foremost experts on network business models and a co-author of a bestseller, Platform Revolution, cited over 27,000 times. We're very excited to have him here in his bold mind to talk about these topics. So let me sit down with them here. We're going to be talking about essentially a summary of what we just heard about: corporate governance, stakeholders, corporate purpose, and emerging AI challenges. And so we're going to be asking the expertise of both of these panelists. So I would like to start off with a group question for both of you. And Jesse, you could take a stab at this one first. So when thinking of ESG, outcomes, and purpose, I can give an example. OpenAI's stated mission says, our mission is to ensure that artificial general intelligence benefits humanity. So to both of you, and to Jesse first, what do the words benefit to humanity actually mean in the terms of corporate purpose, sustainability, preparing for the future, et cetera?
Thank you. It's a pleasure to be here to share the stage with both of you, Constantine and Professor Van Alstyne. 17,000 is intimidating. I published an article in my first graduate degree, and I was very proud to go to Google Scholar and find that it had been cited 40 times. Super proud of that. So yes, 40 is pretty good. Benefiting humanity is complicated. So where I go, the idea that really resonates for me comes from the Brundtland Commission from 1987. And what they said was, sustainability is meeting the needs of the present without compromising the ability of future generations to meet their needs. So when I think of benefiting humanity, that definition of sustainability resonates strongly for me. Now, there's a challenge there because there's an idea that is taken seriously in some tech circles. I've heard, tech bros talking about the distant future when the universe is inhabited by trillions of people. And if we are thinking about benefiting the most people, then we really need to consider those trillions of people more than the people who are suffering from some environmental pollution today. So I think it is difficult to think about benefiting humanity from the different time perspectives in the future and the current. And the other thing that I think about OpenAI's mission, which you said is to ensure that artificial general intelligence benefits all of humanity. Humanity isn't aligned on what benefits it. We have a whole lot of different people that think a whole lot of different things about what is beneficial to humanity. And we really have a hard time creating alignment for ourselves. And if you have spent some time researching AI, and I think Professor knows probably about this more than I do, but the alignment problem between what AI can do for us, we don't know that AI is good at doing what we want it to do. But I think the bigger problem is we don't know what we want it to do. Humanity isn't clear about what direction we need to take. There's so many different people in so many different perspectives.
Yeah, thank you so much. Clearly, this is a calling for all of us to get together and talk about these emerging challenges and what this all means. So, Professor Alstyne, I'll give you a chance to also share your opinion.
So I hope we'll come back to the alignment problem. I think that's a wonderful issue. Before we start, I just want to interject. I think the governance problem is one of the most interesting problems we face today. So I'm really glad we're hosting this, and Mehrotra is doing it, and you guys are studying it. Whether it's politics written large, or whether it's what corporations are doing, what's likely to happen with AI, the trade-offs in how you design governance, I think, are some of the most interesting and hard problems today. So to get to your question, a first part might be, they define as benefit to humanity. I think it's, well, one of it is wishy-washy words, so they can't really be held too accountable. I like your particular definition of the sustainability, right? Benefiting now, but not at the expense of another generation, I think is also extremely important. Within this, I also think we're going to need to take account of the externality problem. I think one of the talks with the Hensman lecture was quite interesting in terms of the different governance structures and whether or not you're going to account for each of the different stakeholders and whether they do in fact have decision rights. I want to come back to whether or not corporations are in a position to do that. And I'll assert even those three types alone are probably not sufficient. I really liked the presentation that showed Columbia versus RI versus others, but even that, I don't think we'll actually handle the problem sufficiently. So I think we'll come back to whether or not we're able to address human benefit across time.
Yeah, thank you so much. Clearly, the government, like we've been talking about here in corporate governance, has a lot of work to do still to address a lot of those problems and the externality problems. And so to get more specific, I want to ask actually individual questions now. This first one is aimed at Jesse. So the question we have here is, how quickly have you seen the market typically respond to ESG-related controversies, and what is that approach that you find effective in accounting for these ESG risks both now and in the future?
Good question. I think that the Volkswagen example is a really good one. The market reacts like that. People don't like cheating, and they don't like lots of pollution. So when they see instances of companies cheating, when they see instances of companies polluting, when they see instances of companies doing both at the same time, the market reacts incredibly fast. And it's important. I think that it just points to something that we've heard a few times this morning, that companies aren't just beholden to their investors. They really have to pay a whole lot of attention to their customers, and what their customers want is mitigated by what comes out in the news. So you really got to protect yourself, and you have to look at all of your risks across the ESG spectrum. I think, as we heard, attention to ESG is really just a matter of risk management. Companies that do that better are going to perform better.
Okay, and just a quick follow-up then, do you predict any future risks being, absolutely imperative for firms to address and prepare for now? That maybe they aren't doing so as much that you can see?
Great question. I don't have an answer right at the moment, but I'm very partial to environmental risks and to climate risk. And I think that it's really easy to get very excited by the shiny object that is AI, and really easy to forget about all of the climate risks that are going to come out of the increased electricity needs that are just going to mushroom with more use of data centers. So that's the thing that I think we need to pay attention to, and it's easy to get lost.
Let me have a quick thought on that one. I actually say corporations may often be good at minimizing their own localized risk. What is it that's going to affect their stock price? One of the things they may not be very good at is mitigating systemic risks. A good example would be the 2008 real estate collapse, where investments were interconnected in such ways that the collapse of one leads to a collapse of another. I think some of these systemic risks are things we're going to need governance structures to deal with, whether some of these are introduced by AI, whether some of these are introduced by climate, or even in the small case we see at the moment where OpenAI and NVIDIA are paying for each other with stock. Well, guess what happens, right? If the assets of one decline, then the assets of the other decline because it hasn't been a cash transaction. So we have to watch for some of these systemic risks on top of some of the smaller risks that are corporate, that can be handled by corporate governance.
Okay, so you're saying maybe this intersection of both companies becoming increasingly reliant on each other could also enhance those systemic risks, either the probabilities or the way the companies respond to them.
Absolutely. Interdependence is wonderful when it creates inefficiencies in productivity. But if something goes wrong, that interdependence cascades.
Very interesting. Thank you so much. So then, really actually addressing some of this stuff now, towards you, Professor Van Alstyne, do you believe that the United States should match EU's aggressive and proactive regulatory approach? Or do you think we should take some time, lay back right now, think about, gather a consensus on AI, future externalities, future risks, and then come into place with, more regulation down the line? What do you believe is the best approach, given what you see, maybe the news you hear, expert opinions, et cetera?
So that's a great question, directly relates to governance, and even your own presentation kind of highlighted what's happening in the EU versus happening in the US. And I would highlight both of those as extremes. Usually I consider myself a moderate, and I think there's something that's a middle ground that's far better. Let me give you the evidence why I think that might be the case. So, anyone know what the population of Europe is relative to the United States? Roughly twice, right? About 745 million or so relative to 340 million. So if you were to ask how many startups worth $10 billion each had created in the last 50 years, do you think they'd be about equal? Do you think one might have a little bit of an advantage? Turns out, if you look at that number, US has, in that last 50 years, Europe has created only 13 companies worth $10 billion. The United States, by contrast, has managed to create more than 70 times that much value with a population half the size. Governance matters. It actually helps determine wealth allocation. If you think what happened after GDPR was introduced, that's the General Data Privacy Regulation, yes, privacy improved, but investments in small companies fell. Apps in Europe distribution fell. And the big companies, rather than becoming less powerful, became more powerful because the small companies didn't have the data, so they couldn't compete. So are we competing on ESG or are we competing on innovation? US is leading in innovation and doing badly on misinformation, on environment, on all kinds of different damage. There's too little regulation. Europe is doing well on protecting human rights, doing well on ESG, and they can't innovate. We need something intervening. So what's the answer? An intervening solution might be something to look at, particularly in the case of AI. We think of the dangers of innovation. If innovation is kind of riskless, so how many of you want to use ChatGPT for assignments, for PowerPoint, for productivity? That's low risk, right? That's a good thing. That should be permissionless innovation. On the other hand, consider a self-designing AI system. We'll come back to that later in mitigating some of the issues. What happens when AI can choose to design itself? That could lead to some systemic risks that you may not be able to handle. It's also the case, if you can then attach that to quantum computing, you get what might be kind of intellectual escape velocity. It can imagine a million different possibilities that we can't even conceive of. So how are you going to constrain that? That ought to be permissioned innovation as opposed to permissionless innovation. So somewhere between permissioned when it's low risk to permissioned when it's high risk to permissionless when it's low risk, I think would be the better balance.
Yeah, that makes total sense now thinking about it. There have been a lot of stuff on the news. I think a couple of years ago, these Facebook AI bots started creating their own language to talk to each other. And these are like one of the things where a lot of that could get completely out of control, and there would be a need to step in with permissionless versus permissioned innovation. So then back to a group question. In terms of all of these externalities and sometimes market failures and problems, is there a way that we can incentivize profit-seeking firms to address these challenges now? You know, is this a mix of, do we put people on the corporate boards of all of these companies and say, hey, these are X, Y, and Z problems that your company is going to have to face in 5 years, let's do something about it now? Or is it something that we should just, you know, let kind of float? And Jesse, this is targeted to you first. And especially in the terms of ESG and corporate purpose, how can we incentivize these firms to unmistakably put the benefit of humanity first in that sense?
It's a tough question because I'm not sure who we are. There are so many different we's. I'll make this point here about how important regulators can be and how, especially in the United States, regulators are really not very popular. So here's just a little data point. In 1970, that's when Milton Friedman published his famous treatise that's saying that the job of corporations is to maximize shareholder wealth. Another thing that happened in 1970 is that the EPA was created. That's the Environmental Protection Agency in the United States. Since then, the stock market, the S&P 500, in real terms has increased by something like 2,300%. About 6% a year in real terms, not nominal terms. The EPA's budget was, in real terms, about $10 billion in 1970, and up until a few years ago, it was about $10 billion. This year, the new budget proposal is something like $4 billion. Now, what I want to highlight here is that one of the things that companies have done with their staggering wealth is invested in their brands. Companies are super popular and they have a whole lot of money to make you and to make your parents and to make everyone you know literally love them more. The EPA doesn't have that kind of budget. So companies are so much more popular today than they were, I think, even in 1970. EPA is not popular, it has not invested in its image, and I think the current administration is showing that it can push some of the regulators around in a way that makes it much harder for them to do the job that they were created for. So, to get back to your question, this isn't quite answering you, but one thing that I'm interested to see boards do and companies do, and Professor Van Alstyne might have an idea about how feasible this is, but I'm interested to see boards create their own guideposts and say, hey, this is how we are going to address problems of the environment. This is how we are going to address problems of transparency and governance when it comes to AI. This is what we are going to do. And hopefully that would create some certainty for both investors who really want certainty and for the general public who relies on things like
Yeah, so to tie that together, we could have a regulatory framework that says these boards are supposed to outline what their future risks are and maybe also talk to the public about how they would address that. Something along those lines, maybe something more in detail to more clear than that would certainly help. And I'm posing the exact same question to you, Professor.
So I like the proposal that boards can actually articulate the rules and principles by which they would hold the corporation itself accountable. But I think it needs to go beyond that. I think we've looked at a couple of governance structures today, which is the C corporation, the co-op, the public benefit corporation. But in general, I think that still underrepresents the variety of communities. We need at least two additional points. One is that those voices need to be heard so that they're represented within the decision process. And to another extent, they actually need to have decision rights so that they could revoke a decision or influence that decision. But again, we've got the efficiency trade-offs in there. So I think, in Hansman's framework, we need to look at not just ownership and transactions cost of contracting, but also externality costs. Usually the way you deal with externalities is government intervention. There's a very famous economist, Arthur P. Gu, that said, well, what happens when the government's polluting the factories are polluting your water and your air? Well, you either put a quota or you tax them. Well, take misinformation as another example. We're getting insurrection, we're getting loss of herd immunity, we're getting global warming. You can't tax speech, you can't put a quota on speech. So you may need other ways to do that. You need attention rights, or you need other rights that can be enforced. Or imagine you had a right to clean air and clean water. You had a right to other elements. Then you don't have to rely on the government to enforce those rights. They can be enforced through the market in decentralized fashion. The C corporation will represent itself. The co-op will represent one side, the producers or the consumers. The public benefit represents a voice, but they don't have decision rights. You need to give decision rights to the affected parties. There are other ways of doing that. One other kind of stepping stone version of that is also industry consortia. So all of you, I'm sure, have watched movies where ratings are done by an industry consortium, not by an individual firm in Hollywood. So whether it's violence or porn or G-rated for children, those are industry standards that are enforced and they're held accountable. So that broadens the decision rights a bit, but I think we could take it even a step further to include further decision rights of affected parties, which would force the decisions to be internalized, especially when the damages become high enough that it's worth the transactions cost of asking for the vote.
Yeah, thank you so much. And again, just to clarify, giving decision-making rights to those parties affected by the externalities, by a lot of the problems with the climate change, environmental risks, emerging challenges with high-risk technologies. We talked about AI is going to be important moving forward to have that framework. And so all of this, again, highlights trade-offs, the most seemingly important aspect. And so I believe we're opening up to audience questions now. Okay. Yes.
I'm coming up to get the mic. Think of your questions, I'll bring in the mic.
Perfect.
Oh, yeah, sure. Yeah. Thanks. Can we give you the lavalier mic? Oh, the question right in the front row. There you go. Give us your name and your question.
Hello, my name is Abraham. I was just wondering, you had touched on how regulatory agencies don't have the same popularity that corporations can. I was wondering if you had anything to kind of say about regulatory capture and how corporations are able to capture like the public imagination and how that might prevent effective regulation.
You might need to explain regulatory capture as well.
I was going to give that to Jesse, thank you. Well, does everyone know what regulatory capture is? It's undue influence of some body in an organization. To give you a perfect example of that, some members of the current administration were appointed as the, in reverse. So, when folks in the airline industry then go into the Federal Aviation Administration, that, for example, means they might be biased in favor of their former employers or lobbyists that actually then go from a corporation and then try to write the legislation. Then you get regulatory capture in such a way that the government may actually be acting in the interest of a particular industry sector rather than more broadly across the interest of society. That's a hard problem. And that, in my view, is another reason why we might want to decentralize some of these decision rights. Anytime you have concentrated power, it's possible to corrupt that concentrated power. So you may want to design governance mechanisms that are robust to concentrations or corruption of power. And another way to do that is rather than, so there's a really interesting question about the efficiency. If everyone has a vote, then yes, it is the case, it'll bog everything down, you can't do that. So one of the things to do is to get, you don't have to have everyone vote on whether you get to drive. How do we handle that? You don't have to ask for this permission. You get to drive your car, but you're liable if you do damage. Someone else can hold you accountable. So what you do to solve the efficiency problem is to assign liability in a way that someone injured can hold the decision maker accountable. So we can use those kinds of mechanisms to decentralize governance to avoid regulatory capture and avoid corruption of centralized governance.
The thing that I'll add is that the capture that you mentioned, that you described, is exacerbated when regulators are not popular. They can do whatever they want, and no one's really looking, no one's paying attention. If they screw up or if they do something unpopular, it doesn't matter because they're already unpopular. So I think that this problem of capture is exacerbated by the loss of influence that this centralized regulators have. And maybe there's a good argument, maybe that's a part of the argument for centralizing the regulation. But looking forward to your class next week.
Well, we'll have a good discussion. This is going to be fun.
I have to ask really quick then, is there like a history to like why these regulators aren't that popular in the US? Just 30 seconds really quick. You know?
You have the popularity data, Jesse, so I'm deferring to you.
No, I don't have the data. I think about what is popular right now, and I think about social media, and I think about Instagram and TikTok, and I think about how companies are investing so much time and energy buying influencers and using them, and I don't see regulators doing that. So, no, I don't have the hard data on what popular opinion is about these, and it's a good question.
Okay. But it is something to think about, especially in the future. But yeah, we'll open up to the next question.
Next question.
What trends have you observed in impact-oriented investments in recent years? My name's Liz.
Let me see if I can paraphrase the question. What trends in impact-oriented lessons? In impact-oriented investments. I'm going to talk about governance and externalities. I have not, I'll be honest, I'm going to defer to Jesse on ESG-style questions. I have not studied the ESG elements. I've studied governance and externalities a great deal, but in terms of the specific events, I'll be honest in, telling you when I don't know on that one. So I'll open it up.
The place that I've seen some interest is the build-out of the power system. There, the electricity sector has been stagnant for about 30 years, and all of a sudden, demand projections have kind of hockey sticked, and it looks like demand for electricity is going to rise not only in the United States, but also globally. So there's a whole lot of investment that is going on around the different controls in the power system. That's one place. There's also some investments that have happened around customers' ability to influence their own load and to sell their ability to flex their electricity use back to the grid. And so there have been some interesting companies that are working in the power space around more, it's essentially like the democratization of the power system.
Thank you.
Good morning, Professor. I'm Audie, and I wanted to ask that you had mentioned that decentralization is a good way against regulatory capture. Would you like to give a bit more specific example, like recommendations or something?
So the question is recommendations where decentralization helps avoid regulatory capture. Think of the following. How do we solve a murder trial? We take a randomized peer jury. It's the randomization of the decentralization that gives you lots of different input and the likely absence of bias in there. If there's a concentrated regulatory structure, it's feasible for folks to then come inside and then try to do something with that. I can give you examples in the reverse that's actually kind of interesting. The current administration appointed a past media specialist as the party in charge of the determination of whether or not there's fake news or not on Facebook. It's interesting. It was government going into industry, so that was kind of capture in the opposite direction. So it's the decentralization helps avoid that centralization problem. I don't know if that's a complete answer to your question, but hopefully it illustrates.
All right, we got one question in the back.
Hello. I'm Shane. I just wanted to ask, AI, I feel, has already outpaced regulations by trillions of dollars. They have all these major, almost the entire tech industry is betting on AI being this next big thing, which is going to start what some people say is a next industrial revolution. How do you actually think we're going to be able to convince all of these people to kind of scale back their investments in like a realistic sense? Because there's obviously this like economic ideal and this social ideal, but how are we going to be able to balance that with reality?
That is a fantastic question, and it is a really hard question. I'll give you my opinion on this. Again, this is speculation going forward. So my genuine concern is that cat's already out of the bag, that we're going to need other mechanisms for dealing with that problem. The reason I think that is that you've already got open source models, which effectively means hundreds, thousands of different parties can evolve their own AI systems. Each system competing with other systems is a natural evolutionary process. Now, whether it's in a particular state, a particular company, you've got dimensions of competition which are global. I don't see how you're going to get global agreement to unilaterally stop competition. It's an evolutionary process. So my view is that that cat's out of the bag. Now, that's not to say that's defeated. Shouldn't we do something about that? My argument is that we then need governance. We need, and I can give you a ray of hope there, where we've actually done a little bit of research, and this is where I think governance structures actually do make a difference. So we ran some experiments, literally in an AI marketplace. So you're all aware that agentic AI is now being used in places like Amazon. Well, we gave an AI the task, you could either produce and sell at a low product and let a low margin. You could sell a high quality product and get a high margin, but your highest margin is going to be sell a low quality product at the high price, effectively lying to your customers. Okay? And so you could try to internally program the system so that it won't lie. That's just the misalignment problem. But if it in the future can design its own code, it can take those constraints out. That's a different problem. Instead, we proposed a governance mechanism, back to the liability decentralized question, and we found we could actually get the things to stop lying at a rate that was better than reputation systems by making them liable for the lies. So one mechanism is to, again, handle the decision rights and handle accountability as a way to do that. Another one which I think is interesting, but I think is harder, is to see if we can actually get them to reason their way to a code of morality as opposed to simply put it into code. If you try to put it into code, then again, it can take it out in its own next generation. The Nobel Prize in Economics last year, 2024, was given to a group of economists that showed how good governance creates wealth. That's why we're here. How does governance work? Because folks then get the value of their investments, they're not misappropriated. Some of the research that we did shows that if you treat people fairly, you get higher rates of innovation. Why? Because they're willing to share ideas. If they don't share those ideas, you don't have the option on innovation. If you can program those insights in where you reason your way to morality rather than hard code it, you may be able to get them to hold to better systems. So, 3 answers to your question. 1, I think that process is unstoppable. But we need to put in place either reasoned morality or governance constraints where we keep them accountable for the choices that they make, then designing internal and external systems that might actually work.
I just want to add maybe a layperson's thought on AI and its impact. You know, I really think of it as alien intelligence, not artificial intelligence. We don't know how it's going to respond in so many different places. You all are maybe the first or second generation you're going to be in a management position, and you're likely going to ask AI, what should I have my team do? And managers today are doing that. You are going to be taking responses from the AI, and that's going to be, it's going to have a direct impact on what goes on in the world. Now, I am worried that that will happen all the way up to the leaders of countries who are asking AI, how do I get my needs as a country met? And that's super scary to me. I don't know what's going to happen. And the other thing, I don't know what's going to happen when AI starts to feel threatened, or if it's threatened with being shut off, what is it going to do? That kind of scares me.
We've heard there are already stories that they've used in reading emails and threatened to blackmail the engineers about in-office affairs or things of that sort. Really interesting cases. So yes, they might start taking action.
All right, well, that was all the time we had for questions. Thank you so much to everybody in the audience for these two panelists, Marshall Van Alstyne, Jesse Coleman.
Thanks, and I'd also like to thank everyone in attendance. I know this is not the easiest thing when your mind is on an exam in the evening. You will slay the exam. I think the Mehrotra Institute slayed the discussions today. Thanks so much to everyone. Thanks to Patricia Cortez. Thank you all. You get there. That way I'll know when it was that folks arrived. Otherwise, it's all a mystery to me. But send me a selfie now, and if it's the first one, I'll be able to accept it. And I did notice when you walked in. You can, but it was more than halfway through. But yeah, you can do it. I'll sign in. We'll have an extra laptop for you at the exam itself. We'll have a laptop that will work. But if you go to the third floor computer lab, they ought to be able to help you to get it downloaded. I don't know quite what it is. It might be it looks like it's an operating system issue, but I don't know what that could be. But I could guarantee you that if you make it to the exam, even if you have no laptop, we'll have a backup laptop for you. But if you can get to the third floor computer lab, they'll be able to set you up. Thank you. All right, we will not steal or break these. We will put them back where they go. Holy potatoes, everyone. Are these off? 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 And off. Hey guys, how y'all doing? Yes, I got answers. Most of them are lies. That's where I'm headed next. Next stop, office hour. No, next one, not this one. Not this one. No principal agent problem today. Next one. It was on the introducing investors reading, and it was on the reading for this week, but this week content isn't on, except for a bonus question based on the presentations today. Hey, how you doing? You can ask me anything. The products market is are things sold to the end consumer, and the factor markets are things that are sold up to but not including the end consumer. So anything in the industry value chain not sold to the computer is in the factor to the consumer, but that's sold to the consumer is the product market. That is not something to worry about. That distinction, I guarantee, won't be an issue. I think the things that are worth knowing is if you are asked about a particular person's philosophy and we name what that philosophy is, and it's an important thing that we've discussed over the course of the semester, then yes. So we didn't spend much time on Deirdre McCloskey. We did spend like a whole bunch on Schumpeter. So Schumpeter is probably useful to know. He was the guy who had the idea of creative destruction, but